Bears are once again perplexed by the stock market. Day two of Powell's speech, significantly higher than expected econ data, an update on an indicator that is actually getting more bullish for equities. Two-year Treasury continues to hit new highs, while the 10-year stays stagnant, inverting the yield curve even more. 5 stocks to watch tomorrow. One sector that looks like it's ready to break out, and another that looks like it's heading for lows. So why didn't the market sell down? Why are semis rallying? Why is healthcare dropping? We're going to go over this, key data points, and what to expect going into the non-farm payrolls number. Bears really just can't catch a break here. Even when they're right, they're wrong. So we've had one day where we actually sold down. We had this doji, we executed perfectly, gap filled, and now we're bouncing again. And all this on the heels of some really bad economic data. So it's staggering the way that we're acting. But the market doesn't care. The market's going to do what it's going to do. And right now it's telling you that it wants to hold in here. Now, this doji, this can obviously break. We're going to go over a lot of what's going on out there and what to expect going through on Friday as well with non-farm payrolls. We really need to address that. But what exactly happened today? Well, the very first thing that happened was Powell spoke. That speech, he said he doesn't know what he's going to do in regards to the next Fed meeting. It was a little bit of a walk back, but not a lot. That gave us a little bit of an umph. But the econ data was just awful. Non-farm payrolls that came out at 8:15, and I know it's ADP, non-farm employment change. It's not the exact same thing, but it is a precursor. 242 versus 200, and the market hardly moved on that. That was at 8:15 today. And again, that's a precursor to what's supposed to happen with the job openings and what is supposed to happen on Friday, which we're going to cover. Instead, JOLTS jobs, we waited for that, came in 10.5. You'll remember yesterday, we went over information and research where Goldman Sachs and JP Morgan said that they might come in under 10 million. Well, not only did they not come in there, they actually came in substantially higher, and everyone was expecting a low number. Well, what we can see is we can see our support level right here, which is that 39.80. Everybody knows that level at this point, right? So now here we are, and we're just watching that wick. We just get a wick right at that 39.80. And you would think that we would crack on that number, and we just didn't. Then we come out, we deal with Powell's statement, and we bounce off what level? 39.80. And then we can just kind of see how the day plays out. Now, for me, it made sense to stay out of the way the majority of today. The only thing I really did or was interested in was just very simply scalping when we got to resistance points. And that's really all I did until later in the day, until we finally, quote, picked a direction. Now, for those who have been following along, we've been looking at this chart called the last hour. It's showing how they're ramping up their buying in the last hour. You can see exactly here, this is your 2 o'clock level. And then you start seeing that level right around here, 2:30, and then we drop down to about 3 o'clock. And you can see from there that wick, and that's pretty much it. That's pretty much the bottom. We never make a new bottom right there. And we just start pushing higher into the close. This is telling you everything that you need to know. So in other words, we're not seeing people panic. We're not seeing that panic, which is kind of crazy considering how awful these numbers have been. Mind you, CPI has been a disaster. PPI was a disaster. They were all higher than expected. ADP and JOLTS higher than expected. Powell coming out, doesn't know what he's going to do. Maybe 50 basis points, maybe 25. It's an unprecedented statement by any Fed chairman. In the 20-something years I've been trading, they usually, when they have a plan, a course of action, they stick with it. And you've even seen some people coming out and talking about their reputational risk. Elleron, who's literally one of the best bond traders in the world, nailed it when he said both of his options on what he needs to do come with reputational risk. In other words, if he decides that he's going to do 50 basis points, he's going to lose credibility. If he doesn't handle inflation the right way, he's going to lose credibility. So he's really stuck, and this is very negative for the market. But the index just did not care. Now, what's more fascinating to this is it just provided great opportunities all day long if you knew where support and resistance were. And that was really it. And it provided opportunities to buy. For me, it was a great day to sit back, watch and wait and see how this played out. And quite frankly, we helped. So we do things a little differently in this channel. I don't predict. I trade. So I trade what's in front of me. You're not going to hear me call for the great crash or call for the great rally. What I do is I just analyze the data. I come up with an opinion. Sometimes I'm right, sometimes I'm wrong, and then I move forward. The goal is to be right more times than wrong, and not to be in that position for longer than you're in for your losers. Now, if you look at what's going on here, all we did was come down and gap fill. If we overlay just the simplest of indicators, okay, and you see your 200-day is sitting right there, okay? See your 55 is sitting right there. You just start going through them and go, okay, well, that might be an issue. That's the 22. Now, the 22 sloping down, and I can't get through it, and I've been unable to close above it for a month. So am I out of the woods? No, far from it. Now, Friday, we have non-farm payrolls. That could be an absolute disaster for the market. Absolute disaster. Now, I don't think it's going to be, and I'm going to show you a couple of reasons why. That could be a disaster. And what my thought is, what if it is? What if it is bad? JOLTS was bad, market went higher. CPI was bad, market went higher. All we're getting is bad economic data, and the market is holding in place or going higher. And they're buying offensive sectors, and we're going to get to that in a moment. But you're wedged in here. So the idea that this is going to make some grand decision, I don't see it. It's very possible that we just continue to frustrate the breakout buyers and the people that are perma-bears. That seems to be the decision that they want to do here, is they just want to do the most amount of damage. Now, you have an evening star up here. You're forming a morning star down here. If you flip that doji tomorrow, the chances of you testing the top of that 22 are fairly good. That's from roughly around 40.36. Now, I read your comments, and I got asked a lot about this panic euphoria model. And I just really want to review this. In front of us is 10 years, and let's look at what's been happening over the past 3 months. So here we are, and we can see how we have flipped this level right here back in mid-January. And then from flipping that zero line, how we pushed during that period in time. And then as we became more pessimistic, the market started dropping. Extreme panic is below this line, and that's where you're at right now. So right now, according to this model, extreme panic is right here, and you are now in an area of extreme panic once again. Now, if we look at these levels and we look at how we're acting in here, we go out 6 months, we can see something that is pretty glaring. Number one, the largest move that we had in October was when we were down in this level with extreme pessimism. Coming into the beginning of the year, you can see how we were down, and then from that level, we ripped. So are we there yet? No, we're not there yet, but we are in a zone of extreme pessimism. And what we're really looking for is we're looking for that pessimism to turn. So more so than just saying, oh, we're down, therefore we want to get involved. I don't think that's the answer. I think the answer is to see how far down this goes before it turns. It could turn here, but we want to look for an uptick. So we're going to continue to monitor this. 2-year Treasury is clearly over 5%. We battled with it all day today, and you're making higher highs, and people are buying the 2-year. Now, for me, I get it. It makes a lot of sense. Sure. And why wouldn't you? But why not go out for 6 months? Traders keep talking about the 2-year. 6 months is paying 5.3% for 6 months on your money. It's absolutely silly. And people are talking about the bond market and how it's an issue. People should be buying bonds. If you're concerned, this is a great opportunity for 6 months, and you'll know more about what the Fed's going to do. And we know that the Fed's going to hike, so that would mean that the 2-year is probably going to continue to go higher. Therefore, you could buy shorter duration and then stagger them out longer term. This makes sense. But what we're seeing here is we're seeing this dichotomy. The shorter you're going, the higher the yield. And so the yield curve continues to invert and invert. Right now, you're about 30 basis points from 6 months to 2 years. Now you're at 4% on the 10-year. So if we're going out for another 8 years, what they're saying is that obviously rates are going to come down. This has always predicted a recession. And again, it is probably predicting that there is a recession. As we went through yesterday, the important thing about recessions are usually by the time we're done them, they announce that it's happened. Okay, the last one was very similar to that, just based upon the pandemic. And obviously that's an anomaly. But right in here, why aren't we rallying with the rest of it? We're not. We're getting to a point where they're saying, okay, that's enough. 4% is a real number. And we're just sitting in here as the short duration is going higher. Now, you can see right here at the downward slope, you can see our death cross right here with the 55 and the 200 on the dollar. Why didn't the dollar rally today? If everything was so bad and all the economic data is continuing to be bad, why aren't we rallying more? Instead, we formed this little wonky doji ahead of non-farm payrolls. Now, there's an equation I'm going to share with you this evening, and it's really a good way to correlate what's going on with the market. But to start with, I want to start with one part of that correlation. So right now, we're looking at the SOX. We've been talking about this for months, that we're setting up for a golden cross, and here it is. Now it's happening, and while it's happening, we're seeing the markets obviously sell off. There has never been a time in history that the NASDAQ has collapsed and the semiconductor space has gone up, period. It just doesn't happen, right? The majority of these names drive the market. We're going to get into a couple of them this evening, but see our line right here? Look at our neckline. And if we just very simply got rid of all the indicators here just for a moment, and we just look at the actual just data point. It's so glaring, the left shoulder, the head, the right shoulder, the neckline. I mean, it's beautiful. And then you basically have this DTL. DTL stands for downward trend line, right? So you can actually argue even that this may be a handle and that this might be a wonky cup, but I think that's a stretch. You could kind of call this a wonky cup, and here I'm sticking with my head and shoulders inverted. So here we are, we're trying to rally. We've got our golden cross down here, pop that back in, and we've got data today that says that rates are definitely going to go higher. Well, that does not benefit technology names. And what are they doing? They're setting up to break out. So just so we're clear, and I know you're looking at that going, well, it hasn't done it yet. No, it hasn't. A lot of things in my life haven't happened yet, and this is one of them. But if you take a look at this level, right, and you see where you're at, and you're going, well, wait a minute. Tomorrow's the 9th. We're in a position here where from the 17th. So you're telling me in the past 2 weeks, I've got a 2-week high close on the semiconductor space, and you're telling me that the market's going to go lower? It defies any kind of logic. At the same time, the defensive sector, healthcare, is selling off. Now, there could be reasons why healthcare is selling off. People are going to point out a myriad of reasons and explain it to me why it's selling off. But the bottom line is, it is selling off. And that's all that matters, is that it is selling off. And why would this sell off if people need to be defensive? People are going to say, oh, it's because Medicare is going to be cut, or they're going to change the drug program, or you guys, when people are trying to find a reason why something happened, like today, trying to find out a reason, well, Jolts had a low retention rate, and that's why this doesn't matter as much. And you're pulling out straws. Your job is not to be an economist and to make excuses for the market. Your job is to trade. Now, if you're looking at these levels and you're just breaking support level after support level, unable to rally over support level when the market runs, funds are selling healthcare. They are buying semiconductors. It is glaringly obvious at this point to anyone that knows how to just look at price action. If you look at the SOX, and the SOX is closing at highs of the day, and healthcare is closing at lows of the day, it's not rocket science. So just kind of keep that in mind. You're not going to have a market that is going to fall apart with semiconductors hitting new highs. Your job as a trader is to analyze data and then make the best decisions possible. If you were to look at this and you didn't know what it was, you would clearly say it's going higher. It's NVIDIA. If we look at NVIDIA and we look at this level that's been a battleground for some time, and we see how we're breaking out of this, you can see the push, the pullback, the push. When did that all start? When did it start? Right around what? The last hour. Remember the graph that we showed yesterday? I try to connect all these videos and then follow up on them. Comment on that if you like that I'm doing that follow up from the previous day video, or if you'd prefer just to see new content. I think it's more helpful to understand the nuances. Now you see the pullback and then the rally. This is as clean as it gets, guys. And you have this huge base. Well, I think it's a huge base for a 1 minute chart, and then we're breaking out of it into this. This is something we started buying between 232 and 238, and been playing with it for a long period of time, doing very, very well with it. It's actually in the newsletter. If you don't get the newsletter, there is a link in description. It's free. But this looks to me like we're just going to keep pushing. So we can see our first close above our key level. We can see our golden cross. We have a gap fill up here, probably to 260 is what I'm thinking. I think we're going to wind up getting up there. Maybe we do, maybe we don't, but that's my first target on it. I try to plan out a target just so I can have it like an estimation on where I think and how much we could possibly make on an idea. And that's really what I'm looking at, this 260 level. In front of us is a very simple relative chart. This is the SOX divided by XLV. Think of it as offense divided by defense. It's the best way to think about it. If you look at this chart, what does it look like? It looks to me like we're breaking out. That's what it looks like to me. It looks to me like I have a breakout. On a relative basis, even though the SOX has not broken out yet from its base, it's broken out relative to XLV, which is a precursor to the move. This is the SOX divided by the XLV. The orange line is the S&P. If you look here, you can see some pretty key things. Sometimes the SOX will actually hit a low or a high before the actual index. Sometimes it'll peak before the index actually does. Sometimes it'll bottom maybe a little bit after that. But once this bottoms in, it's pretty defined. We can see that here pretty clearly. It's not exact, but there is a very high correlation to this. And if we start seeing here these levels, and we're over here and we're flipping and we're breaking out, to think that we could get back up here and maybe follow the same high correlation that we've had for a pretty long period in time, I would say, right? You can kind of see this correlation. I mean, it makes a lot of sense. We're only going back 4 years here. And we look at that correlation, and then we just kind of zoom in on this particular time frame. And we've got a little bit of a divergence of it, doesn't it? And they usually correct themselves. So as we're flipping right here, there is a possibility that this is going to follow suit and flip as well. Now, Dick's Sporting Goods, actually excellent earnings, just mind-boggling, good quarter, raising guidance, breaking out of all-time highs. This should be on your watch list. It could have cared less what the market did yesterday, and it certainly did not care again today. I currently have a position. The biggest problem with this trade that I see is that I don't have a spot for a real stop. I've got this right here, and I finally am getting over it. So for me, I watch these upper channels, and I watch them a lot. And we stopped there the other day. Now we're flipping. Now, when you flip an upper channel, for those that have been following me on Twitter for years or been on here for, I think we've been on here almost 2 years now. When you flip these upper channels, you can go parabolic. A lot of people will say, oh, I don't buy it because we're in the upper channel. That's fine. There is definitely something to that. It works until it doesn't work, right? So now when you're flipping, you want to pay attention to this. These can go parabolic. If this market heats up, this should be something that's on your radar. Meta had every single reason to break down today, and it just very simply did not. All we did was form a hammer right on a key support level, and we could have broke there. If you flip that hammer tomorrow, this might be one that you're going to want to watch. KALA. Now, I'm not going to get into the company, what the company does. This is very simply just looking for a trade. But right here, you have a position where you have a bullish engulfing sitting right on a major resistance level, and you closed over it. You tried to rally later in the day, and then it pulled back a little bit, and you're sitting there. I don't know if they're going to come out with a secondary. I don't know if this is actually going to do what I think it's going to do. You never know with these little guys, but I would watch this tomorrow. This to me seems like it's setting up. I started buying the other day, and I don't usually play these names. Usually I'm a day early. You can see that pretty clearly here. I can certainly say it. And now you can see the move that we've made, and we'll see how it's going to play out from here. But I would have that on my radar. If you pop in volume by price right here on the other side of it, you can see very clearly from this far back, and really all we want volume by price for is where this changed, right? Where did it change in the market? Well, we really changed here. This is when we really started to see that change. And you can see that shelf right here. Now, if we can get over that shelf, which just really ties into that 24, you have pretty much blue skies above. So flipping something like this could lead to a push. Now, in regards to Asan and earnings tonight, this was pretty much a no-brainer. They beat by 45%, losing less money than expected. They beat on the revenue side. Conference call seems to be going fairly well at the time of recording this, and you can see that we're up here about $5. It is very hard for the NASDAQ to go down if these companies are going to keep beating expectations and raising guidance. Companies that are worried about the next quarter are not raising guidance. And that's exactly what we're seeing happen here. We're starting to see the new set of leaders start to rise from the ashes of what was 2021-22. So watch this doji tomorrow and comment on this video. Tell me what you like about it, don't like about it. Please put the name of what you're watching in down below in the comments. I'd like to look at the charts, and usually I will post 1 or 2 of them in the community. So if you're interested in seeing those charts, you need to be subscribed to the channel. And let me know what other content you want me to come out with. I've gotten a lot of really good ideas. It's why I did the day trading video. It's only 12 minutes long. It's a really simple program to follow and can probably add value no matter where you're at. But as always, have a great evening, everyone, and trade to win tomorrow.